Today, I want to talk to you about 5 tax increases that may be coming to Canada. As we all know, taxes are a necessary part of funding our government's programs and services. However, it is always important to be aware of potential tax increases that could impact our personal finances and our economy. Here are 5 tax increases that Canadians should be aware of. Carbon tax. The carbon tax is a tax on greenhouse gas emissions. The federal government recently announced that they will be increasing the carbon tax from $40 per tonne of carbon dioxide equivalent to $170 per tonne by 2030. This increase is expected to raise the cost of gasoline, heating, and electricity for Canadians. Capital gains tax. The capital gains tax is a tax on the profit made from selling an asset, such as stocks or real estate. The federal government is considering increasing the capital gains tax rate from 50% to 75%. This increase would impact individuals who have invested in stocks, mutual funds, or real estate. Digital services tax. The digital services tax is a tax on companies that provide digital services, such as streaming services or online marketplaces. The federal government is considering introducing a digital services tax of 3% on companies with global revenues of over $1 billion. This tax is intended to level the playing field for Canadian companies that compete with multinational tech giants. Wealth tax. The wealth tax is a tax on the net worth of individuals. The federal government is considering introducing a wealth tax of 1% on individuals with a net worth of over $20 million. This tax is intended to address income inequality and raise revenue for government programs. Now, I know that tax increases can be a sensitive topic, and many Canadians may be concerned about how these potential tax increases will impact their finances. However, it is important to remember that taxes are a necessary part of funding our government's programs and services. The key is to ensure that tax increases are balanced and fair, and that they do not disproportionately impact lower-income Canadians. It is also important to consider the potential benefits of these tax increases. For example, the carbon tax is intended to reduce greenhouse gas emissions and combat climate change. The digital services tax is intended to level the playing field for Canadian companies that compete with multinational tech giants. And the wealth tax is intended to address income inequality and raise revenue for government programs. In conclusion, while tax increases are never popular, they are sometimes necessary. Canadians should be aware of potential tax increases, such as the carbon tax, capital gains tax, digital services tax, wealth tax, and corporate tax, and consider how they may impact their personal finances and the economy as a whole. It is important to ensure that tax increases are balanced and fair, and that they are implemented in a way that does not disproportionately impact lower-income Canadians. Thank you for your attention, and I hope this video has been informative.